Why is Zoom zooming? This week, or actually the end of last week, Zoom went public. That's the video conferencing service. I do a lot of work on Zoom. I love the platform. They've done a great job of building a hugely loyal fan base. And even though they're in a very competitive space with some very large companies, Cisco and WebEx and some of these other big companies, they've really done a great job of infiltrating that marketplace. But this post isn't really about Zoom. Zoom is a company that went public. They've done very well. Their stocks run up. It's been an excellent IPO, and there have been a number of them that are coming out. This isn't really so much about the IPO, but I want to give you a little sense, some inside track on kind of the bigger market, kind of some of the things that are happening in the marketplace, because that's really what you need to understand. Why are these certain stocks really going forward? Why are they doing so well? So here's the deal. Zoom is a subscription-based service. Every single month, there's a charge to people's credit card. Most of them pay a year in advance, but there's a charge. It's very predictable revenue. 10 years ago, let's think about this. How many of these automatic charges did you have on your credit card? I don't know about you, but I didn't have any. At that time, I was very careful not to let anybody pound on my credit card every single month. But now I probably have 30 or 40 of these between Netflix and Hulu and all the different subscriptions that we have in addition to Zoom, and every year these things renew. Well, think about this. If you have a business where you know that every single month you're going to have renewals, that money is pretty predictable. It takes longer to ramp up a subscription-based business, but it also takes a lot longer for that kind of business to fall apart. And so businesses that are built on the back of a subscription model are very, very valuable on Wall Street. And Wall Street now values these companies at a much higher rate. So you've probably heard of price to earnings ratio, and those numbers typically, I don't know, 5, 10, 20, whatever the number is. And there's different industries have different ratios based on their probably how their potential and how things are working out. But these numbers are actually going higher for certain kinds of companies, because some money is better than some other kinds of money. Certain kinds of revenue are better than other kinds of revenue. And the kind of revenue that's best, at least what Wall Street likes the most right now, is this subscription revenue. So if you put together a business based on subscription revenue, you're going to find yourself in a darling position. The other situation is that if you want to invest in companies that are doing things that are subscription driven, you're probably going to pay more for those companies, but the companies also are likely to be more predictable in their outcome and the way that they generate their money. So think about those things. The stock market has fundamentally changed in the last several years because of all of the subscription-based businesses. So when pundits say, well, the stock market's overheated, the numbers are too high, the reason that when I go on the media and I talk about my opinion, I don't think that we're overheated. I think that the stock market can really support a much higher level than it's ever supported before, because so much of the revenue is non-transactional. It's not based on who knows where the next sale's coming from. It's like, if you know where your next meal's coming from, you're going to be able to relax and be a little bit smarter in the way that you operate your business. And these subscription-based companies are not on the hamster wheel like some of the other ones. And anyway, that's really the inside track on how some of this new money's moving, why the stock market's really okay the way that it is. I believe so, at least. And it really is a way for these younger companies like Zoom and so many others to accelerate their growth and build and use it as a platform. So use those techniques, use some of this information, the inside track that we provide you, so that your business can have the insights that it needs to be able to profit from the inside, or the inside insights that we share. So listen, that's it. Now go out and stake your claim.